In this video, I'll be revealing the 401k tax trap that could be costing you everything in retirement, and why the account you thought was helping you might actually be destroying your financial future. Through working with clients who discovered their massive 401k balances were actually tax time bombs and analyzing the hidden costs that most people never see coming, I've identified the single biggest trap that turns retirement savings into retirement disasters. And that's exactly why I'm making this video today, to expose the double taxation trap that's built into 401k accounts and show you how to escape before it destroys your retirement income. If you're new to this channel, my name is Cody Gunn. I'm a CFA charter holder and the founder of Arrowstone Wealth, where we help clients retire early through smarter investing and lowering their lifetime taxes. With that, let's get into it. When you look at your 401k statement, what do you see? You see decades of hard work of saving diligently and watching that balance grow. You see a number that finally feels big enough. But here's the uncomfortable truth the industry never wants to talk about. That number is not all yours. You have a silent partner in your retirement account, and his name is Uncle Sam, and he's waiting patiently for his fair share. This brings us to the first and most vicious part of the trap, the double taxation effect. For every single dollar that you withdraw from your traditional 401k, it's taxed as ordinary income. You probably knew that. But here's where the trap springs shut. Those very same withdrawals are counted as provisional income by the IRS, which can cause a huge portion of your Social Security benefits to become taxable as well. Think about that for a second. You've paid taxes your entire career to fund Social Security. Now, because you're withdrawing from the retirement accounts the government encouraged you to use, the government gets to tax your Social Security benefits too. It's a tax on top of a tax. But wait, there's more. It's like a terrible infomercial for losing money. If your income from those 401k withdrawals pushes you over certain thresholds, you also get what are called IRMA surcharges. That's a fancy acronym for the government charging you more for your Medicare Part B and Part D premiums. So let's recap. You withdraw from your 401k, you pay income tax on those withdrawals. That withdrawal then makes Social Security taxable, and just for good measure, it makes your healthcare more expensive. Perfect. That's not a retirement plan. That's financial quicksand. The most insidious part of this trap is that it's completely invisible while you're saving. So for 40 years, you get a tax deduction and think you're winning. But in retirement, the math flips, and every dollar you pull out triggers a cascade of new taxes. I have literally sat across the table from people with $1 million 401ks who were shocked to discover they're paying more in taxes in retirement than they ever did while they were working. The double taxation trap destroys income, but the forced distribution requirement ensures you can't escape even when you don't need the money. Now, you might be thinking, okay, that sounds bad, but I'll just be careful. I'll only withdraw what I need to so I can stay in a lower tax bracket. That's a nice thought. Unfortunately, your silent partner, Uncle Sam, has other plans. Starting at age 73 or 75 for those born in 1960 or later, the IRS knocks on your door and says, congratulations on saving so diligently. Now start taking the money out whether you want to or not. These are called required minimum distributions, or RMDs. And they're not a suggestion. The amount you're forced to withdraw increases every single year based on the IRS life expectancy tables. By the time you're 85, your mandatory withdrawal could be nearly double what it was when you started. Now picture this. It's 2008 all over again. The market has just crashed 40% and your account value is in the gutter. The absolute last thing any sane investor would want to do is sell their stocks, but the IRS doesn't care. Your RMD is due and you're forced to sell your investments at the worst possible time. Isn't this video just a ray of sunshine? And if you decide not to take your RMD, the penalty used to be one of the most brutal in the entire tax code, a 50% tax on the amount you should have withdrawn. They recently reduced it to 25% or 10% if you fix it quickly. I guess this is the IRS's version of being generous. A 25% penalty is a financial malpractice. I had a client bring me an account statement one time for his dad's IRA, and I discovered he had never taken an RMD. And when I calculated the penalties, it was basically everything that was left in the account. So be careful because this does happen. This isn't retirement planning. It's a hostage situation where your own money is being held against you. RMDs rob you of the single most important tool in your retirement: control. You can no longer manage your tax brackets. You can't time your withdrawals. The government dictates the terms, forces you to withdraw more than you actually need, accelerating your tax problems, and potentially pushing you into double taxation traps that we just talked about earlier. Forced distributions eliminate control, But the tax rate uncertainty trap means you're gambling on future government decisions about your money. Here's the fundamental risk of 401ks that almost no one talks about. When you defer taxes, you're making a bet. You're betting that the tax rate in the future will be lower than they are today. And let me ask you a very simple question. With the US national debt soaring past $34 trillion and growing, do you think tax rates 10, 15, or 20 years from now are likely to go up or down? Your 401k isn't just your account. It's a partnership with the government. You contribute the money, you take all the investment risk, but the government owns a share of it. And they get to decide how big their share is whenever they want. They can change the rules of the game right when you are in the middle of playing it. If your tax rate today is 24%, you might think that that's manageable. But what if future Congresses raise that to 35 or 40%? Your retirement purchasing power is instantly and permanently slashed. This is a risk far greater than market volatility. A market crash can recover. Your portfolio can bounce back over time, but a tax rate increase is a permanent transfer of your wealth to the government. It's gone forever. Many financial experts believe today's tax rates are historically low. By keeping all of your money in a tax-deferred 401k, you're essentially giving the government a blank check drawn on your retirement account, and they can cash it whenever they need to. You're gambling your future on the fiscal responsibility of some politicians. Good luck with that. Now that you understand how the 401k trap works, if you're ready to explore strategies for planning your dream retirement, click the link in the description below and book a call with me, where I will give you some actionable advice tailored to your specific retirement plan. Now let's talk about what happens to your 401k when you're gone. You worked your whole life to build this nest egg, hoping to leave a legacy to your children or other loved ones. Unfortunately, due to rule changes a few years ago called the Secure Act, your 401k might be the worst possible asset that you can actually leave to them. Under the new rules, most non-spouse beneficiaries, like your children, are required to completely drain the IRA or 401k within 10 years of your death. This creates a massive tax bomb for your heirs. Think about this for a sec. Your kids are likely in their 40s or their 50s. They're in their peak earnings years, already in their high tax brackets. Now, on top of their own income, they're forced to take huge distributions from your 401k, pushing them even into higher tax brackets and sending a massive chunk of your legacy, 30 to even 40% or more, straight to the IRS. It's even worse for a surviving spouse. They go from a favorable married filing jointly tax status to a much harsher single status, often with the same amount of taxable income from RMDs. It's brutal and often unexpected tax right when they're the most vulnerable. Compare this to other assets. If you leave behind stocks in a brokerage account, your kids get a step up in basis, which means all the capital gains are wiped out and they're tax-free. If you leave a Roth IRA, they inherit it completely tax-free. The 401k is almost uniquely designed to create the maximum possible tax burden on the people that you love the most. The estate planning trap punishes your heirs, but understanding the escape strategies reveal how to transform your 401k from a liability to one of your best assets. Okay, I know that was a lot of doom and gloom to start, but I didn't bring you here to scare you. I brought you here to prepare you. It's time to shift from defense to offense, and there is an escape hatch from this trap, and it's called strategic Roth conversions. A Roth conversion is the process of moving money from your traditional tax-deferred 401k or IRA to a tax-free Roth account. Yes, you have to pay income taxes on the amount you convert in the year that you do it. But in exchange, you solve almost every problem that we've just discussed. First, converted money is yours, free and clear. It grows 100% tax-free forever. Second, Roth IRAs have no required minimum distributions for the original owner. You're back in control. You never have to take a penny if you don't want to. Third, qualified withdrawals from a Roth don't count as income. That means they don't cause your Social Security to become taxable, and they don't trigger those nasty Medicare IRMA surcharges. And finally, you create a tax-free inheritance. Your heirs can inherit that Roth IRA and enjoy a tax-free withdrawals, and it protects your legacy from the IRS. By paying the taxes now on your terms at today's known and likely lower tax rates, you're methodically disarming the tax time bomb before it has a chance to explode in your retirement. Now, this part is really critical. A Roth conversion is a scalpel. It's not a sledgehammer. You can't just convert your whole 401k at once, or you'll create the very disaster you're trying to avoid. Timing in this situation is absolutely everything. The goal is to strategically convert just enough money each year to fill up the lower tax brackets without spilling over into the higher ones. For many people, the golden window for conversions is the period after they retire, but before Social Security and RMDs begin. Your income is lower, placing you in the perfect position to execute these conversions at minimal taxes. A multi-year strategy is almost always the best approach. You might convert $50,000 this year to stay within that 12% bracket, another $70,000 next year to fill up the 22% bracket. You coordinate it with other life events, deductions, or even charitable giving strategies. This methodical approach allows you to systematically move money from the taxable column to the tax-free column over 5, 10, or even 15 years. Poor timing here can actually cost you a fortune. Optimal timing, however, can save you hundreds of thousands of dollars in taxes over your lifetime. It's one of the single most powerful wealth protection strategies that a retiree has. Now that you understand the complete escape strategy, let's look at how to implement your personal plan to avoid the 401k tax trap. So how do you actually put all of this together? It's a very, very clear framework. Step 1, comprehensive analysis. You can't chart a course without a map. You need a full projection of your 401k balance, your estimated RMDs, your other income sources, and what your tax picture will look like with and without a conversion strategy. Step 2, a multi-year plan. Based on that analysis, you build a year-by-year conversion plan. How do you convert each year to optimize your tax brackets? This isn't guesswork. It is a calculated plan year by year. Step 3, coordination. Your conversion plan must be coordinated with everything. When you'll turn on Social Security, when you'll need to draw from other accounts, and how you'll pay the taxes on the conversion itself, ideally from a non-retirement account. Step 4, you monitor and you adjust. Tax laws change, life happens. Your plans need to be flexible enough to adapt. This is not a set it and forget it strategy. The key to success is gradual implementation. You want to methodically bleed the tax liability out of your account over years, not create a massive financial wound in one single year. This takes discipline, planning, and often professional guidance to navigate the complexities and ensure you don't accidentally create new problems while attempting to solve the old ones. Now that you understand the 401k tax trap that could cost you everything and the strategies for escaping it before it destroys your retirement income, you can take action to protect your financial future rather than falling victim to hidden wealth destroyers. If you feel like you need more personalized help for your retirement plan, click the link below to book a call with me, where I will analyze your specific situation and give you some actionable advice for your retirement. Thank you so much for watching this video, and I look forward to seeing you on the next one.